Hi everybody, welcome back to T.U.B Investing YouTube channel. Okay, this is my third video right now since the restart. I'll talk about the 10 companies listed here. I've talked about digital turbine apps, which I'm still vested. I've sold Tremor International, which I also talk about the reason why. If you want to see this video, please go back to my video listing and you can see it. See my last two videos previously, right? So having said that, what is the company that I'll be talking today, right? It will be from the 10 companies in one of the 10 companies in the listing, but I'll be going through this flow right now. From the feedback from my friends, right? They said that the videos were a bit boring last time. The slides were a bit too dark, so I've changed. As you can see, I've changed my design. I just want to give a bit of how I look at the company, right? I will talk about my position, my ticker, my market cap. I'll try to explain my understanding of the business, their competitive edge and the competition, and what is the catalyst to buy or sell, the reasons behind the risk. I'll look at the valuation and ratios, and I will stop with conclusion, right? For this company, I'll be talking about risk first before I talk about reasons that I may want to keep this company, because I'm already vested and I'm not really looking at valuation ratio, which I'll explain in the conclusion itself, right? So the company that I'm looking at is actually showing the FIFA World Cup right now. And it is one of the streaming services that is showing all the 64 games in the FIFA World Cup, and I'm showing here the two surprise winnings games that won in the FIFA World Cup, where Japan won Germany 2-1 and then Saudi Arabia won Argentina 2-1. So I also hope this company will turn around soon and they will make they'll win the market in 2023. The company is Football TV Incorporated, right? So the ticker is FUBO. So before I continue to talk about the company, do note that I am not a financial advisor. Anything stated here is just my opinion. And then if you like this video, please subscribe, and please ring the notification bell. I don't have any animation for it, but please, I do appreciate all the likes and subscription. Okay, thank you very much. So if you like this, do give it a thumbs up. Okay, thank you very much. And so, my initial take on the company, I remain vested today. I've written over 6 articles on my blog. Very long. I used to say that it's my 10x potential, and right now it is definitely easier to hit 10x now at a market cap of 544 million. It has fallen 82% over year to date at about below $3, right? I think it's about $2.70+% with a high short interest of 25%. Do take note that the company actually went up over $60 at one point in time, and now it's at less than $3, right? So why does this company went through this up and down, right? So when it got listed through a reverse takeover, it stated that it's a data-driven company that focus on sports and ask people to come for sports, stay for the entertainment streaming services. It started as soccer-centric streaming services and is available in US, Canada, and Spain, right? Recently acquired, I wouldn't say recently, but probably last year, it acquired Molotov, which is also a free streaming services in France, and this means that they also have business in France right now, right? And their business is focused on 3 major trends right now. The cord cutting trend, right? Which there's a switch between cable to streaming services, and there's about 70 million of cable subscribers still in the US that are yet to cut the cord. The shifting of TV ad revenue from traditional to digital TV, and then the sports wagering services, right? So right now, sports wagering is all ongoing in the US, right? But I'll explain a bit more sports wagering on Football TV, which is there's some interesting progression right now. So if you look at the latest earning transcript, right, they seem to have repositioned themselves, stating that they have a high quality product with innovative technology, stating that they are a premium platform. And they want to keep their viewers, users engaged, but the only thing that remains true is that they still collect significant data points, right? And their strategy has stated very clearly here that they want to aggregate the best sports and entertainment content, keeping customers engaged to drive advertising sales and upselling subscribers on additional content and features around the content cost itself. So to summarize, they continue to be data driven with the core of come for the sports, stay for the entertainment, but it is no longer just a streaming service. It's an aggregation streaming service where it aggregate different contents, and it focuses on interactivity and to drive the to keep user engaged and to drive the advertising sales. And through that, right, they also try to upsell additional content and features to the user, keeping them on board, continue to interact with them, and this flywheel will continue to drive up the advertising sales, and eventually they will grow their revenue and become profitable. So a point to note that they are not profitable at this point in time, and they have a significant cash burn, which I'll explain later as well. And although there's some sort of like a repositioning in their businesses, but they remain on track, right? On these three major trends that they are on, they remain focused on the viewers that's cord cutting. That these cord cutting viewers, the shift from cable to streaming services, they continue to focus on them, and they continue to focus on the TV ad revenue that is changing from traditional TV to the digital TV, and as well as the sports wagering sector, right? I'll explain more on this point, so I hope just continue to keep viewing this video. So right now, for them, right, whether do they, I just want to explain their competitive edge and the competition, right? So for aggregation services, in my opinion, there's no competitive edge. Right? It's just aggregate all the contents. Any website can do that, and there's actually high competition from cable TV and other streaming services right now, and any price war will kill their business, right? So how they reposition themselves in the price, in terms of pricing, is that they are much cheaper than cable TV, and stacking of I would say SVOD services. So on the point of them being cheaper than the cable TV is true through Statistica and then through cabletv.com, right? They are, in 2021, the average user actually paid $100 for these pay TV services, and the average cable TV plan seems to be about $87 as of November 17, 2022, right? So they are still at $69.99. They are still cheaper than a cable TV. But with regards to stacking of SVOD services, right, such as Netflix and Disney Plus, I am not really seeing that point, because I view them as individually competition to football TV as well. So I won't take that point into consideration. However, with so much competition and without a competitive edge, how are they positioning themselves, right? So since in my opinion, there's already price war happening among the streaming peers, right? Between Netflix, between Disney Plus, between Warner Brothers Discovery, HBO Max, and then even in terms of live sports, right? YouTube TV and football TV itself has already some sort of some pricing in itself, right? But I feel actually football TV itself is trying to differentiate itself through its product, right? They have a focus on live sports. It's a niche market, but they actually market it as a premium service. So only people who want a premium services, who is focused on live sports, will want to use this service. And with that, right, they actually, that's one of the reasons why they're able to go after cord cutters in cable TV, right? Because they also market themselves as a cable TV alternative, as it is. They aggregate the sports content and the entertainment content, and that's what the cable TV do, right? And even on that, they even don't mind paying a higher cost, right? To acquire customers. So they actually maintain 1 to 1.5x of the cost to acquiring customer, right? So they use features and upselling and also to keep these users and then to drive revenue and then eventually profitability in future. And one of the main as you listen to the flyer just now, if this user keep coming in, they can actually drive up the advertising revenue as well, right? And on sports betting, right, although one of the main points, they actually closed their self-operating gaming department. So one of the history is actually when they started this business, they wanted to focus on this sports wagering based on themselves, use themselves as an entity to enter the sports wagering, but it was too much of a cash burn for them, and so they are actually focusing on partnering instead. And then I'll explain a bit more on this sports, why they closed gaming and how their cash burn in the slides later. So overall, in terms of competition and whether they have a competitive edge, it's still a very tough business model, but they have positioned themselves using their product, marketing themselves as a product that is focused on sports, and they already stated they are premium, and they try to use features and upselling and they don't mind paying more for a customer, and they use features and upselling to drive revenue and then eventually profitability and free cash flow. And obviously, when there's more users engaged, advertising helps as well. So why they close gaming? Basically, with all the words down here that's taken from all the recent earning transcript, right? The main thing is they want to focus on profitability. They had to close gaming so that they can stretch their dollar longer, and then rather than using their own capital to invest in this sports wagering sector, they want to partner instead. A point to note is that they do still have the technology, although the department is closed. So in that sense, the cash burn will probably reduce moving forward, and they can do partnering, which could increase their revenue, give them a new revenue channel instead, right? So another point is that actually they stated that in the previous slide, they also state that this sports wagering sector is very competitive. You can see that as a new entrant, I consider them as a new entrant, and they are not focused on sports wagering itself, right? So it's actually very hard to excel in it, in my opinion. And then for one that is actually focused on it, that is a new entrant, in my opinion, is DraftKings, and they do have difficulty to maintain good margins as well, and free cash flow, and generate free cash flow. If you look at their profitability grades D-, and they are making significant losses as well. So basically, the point about sports wagering is too competitive. There are too many companies right now, and if you are a wagerer, if you are a gambler, and you are already using a platform right now, you will not try to change a platform to use another platform, right? It's quite hard, right? So actually, the switching cost might be there, right? And then do take note that when we are talking about companies, right, these are official company that's around the internet, that's marketing themselves, right? But how about the unofficial one that's in the background, right? You do know that when it comes to gambling, there are also many underground services out there. So I would say it's very, very competitive. There's no point in staying in this gaming sports wagering business. So they close down, to me, is a positive thing, right? Where they want to focus on free cash flow, profitability, and trying to reduce their cash burn and dragging their capital and dragging their cash to over a longer period of time, right? So with that, right, I want to talk about one of the risks that I've been talking about them over numerous times, which is their cash burn, right? So right now, actually that's the main risk, but management emphasized that they do have enough cash for 2023 and a modest requirement only in 2024, right? So they do have about 300 million cash right now. So if that's enough, right? If you look at the current loss in this quarter, right, it's actually 152 million. It's damn high, right? But there is a non-cash impairment charge, and there's operating expenses incurred from wagering business that will not continue anymore, right? So if you look at it, operating cash flow is actually negative 76 million, and then if you remove which includes 8.6 million of operating cash flow associated with wagering business, if you take these figures out, one whole year the cost is about 272 million. And another interesting fact is that in the 10Q, right, they also stated that they have paid upfront payment totaling 42.9 million for their sports right agreement, right? So that actually goes into 2023, where they have paid about prepaid sport right about 30 million, So in that sense, in my opinion, right, next in 2023 there will be lesser cash spent on sports rights to pay for sports rights, and that could also reduce their cash burn in itself. So to summarize on that, their prepaid sports right, reducing their cash burn in 2023, which will not be recurring. This prepaid amount will not be recurring in 2023 again. So that could be a reduce of cash burn. And then with closing of their sports wagering sector, they will also save more cash on that. And overall, it seems like they will probably spend about 250 million over the next 1 year if they execute well, right? In my opinion, so that is definitely less than what they have right now. Cash on hand is about 300 million, so that they definitely will not have any cash call in 2023, right? So in that sense, one of the main risks, the cash burn, or the risk of cash burn will still be there, but they'll definitely survive through 2023, in my opinion. So any second risk that is significant is probably the debt. And if you look at it, their debt is mainly focused on their convertible notes, right? Which is actually stated at 3.25 interest rate, which is not very high at this moment, and it's fixed, right? I've checked the last 10Q is also 3.25, and right now last 10K is 3.25. Now as of now, this 10Q is still 3.25, so it's actually fixed, and that's not high with regards to the current interest rate environment. And do take note, the conversion price is $57, and right now the current company's price is about $3, less than $3. So nobody will convert them as of now. So they're just meaning that a company will need to keep paying the interest on these convertible notes, and they have holders can convert only on or after November 15, 2023 or so. So actually they can't convert now as well. And do take note, the company has a free cash flow goal target in 2025. So if that happens, there could be a rise in share price. If the share price is higher than $58, $57.78, companies may start to buyers of these convertible notes will start to convert their share and then sell them off, hopefully. So with that, I would say that the risk on the debt is actually low, because the interest rate is actually fixed, and then 3+%. So that is not significant in my opinion. So with that, with all the risks being talked about and explaining of their business, their flywheel of engagement, upselling, and then driving advertising, this will eventually increase their revenue, and then hopefully reaching profitability, and then reaching free cash flow target in 2025, right? So what are the catalysts and tailwind, right? So if you look back right now, I've talked about the reduction in cash burn and no cash call in 2023, so that is a catalyst, that's tailwind in itself. Interest rate is not high, and then these notes are only redeemable in 2025, so that is so that they don't have a significant debt that needs to be repaid over the next 2023 as well. And so in these 2 points, meaning that their cash can actually their cash is definitely enough for them to burn through 2023 and even into 2024 Q1. And then with closing of Football TV, doesn't mean that they will not do anything right now. They will still focus on sports wagering. I would say that there is actually a potential it could potentially become a platform as a service for sportsbook provider, and with numerous partners in that sense, and that will probably help give them a new revenue channel itself, right? So last year they actually acquired this company Edison.ai, and right now they've actually stated in some press release that that will allow this Edison.ai will allow them to allow users, right, to, for example, select a World Cup jersey that a player is wearing during the World Cup match, right? And by selecting that, it will drive them into the e-commerce space where you can you can tell the users that, do you want to buy such a jersey, right? So they are actually moving into e-commerce, which is a new potential business revenue stream, right? And then definitely the recovery in advertising. Advertising right now seems to be on a downtrend in the Q3, third quarter. Q4 probably, I'm not sure about Q4 because results not out. But if there's a recovery in advertising trend, definitely that will be a tailwind for the company itself. In the earnings call, they also said that there's cost synergies of 75 million between 2022 to 2025, probably due to the, I would say, a streaming of the operations between Molotov and Football TV. So that is significant. That also helps in a way, and definitely reducing operating costs over maybe spreading across the 3 years stated, right? Sorry, 4 years stated. So an interesting wildcard is that I think the CEO has stated repetitively that they've actually signed this contract with Ryan Reynolds, right? They're his maximum effort production, right? And they're actually managing all the advertising sales for this platform that is going to be on for this production house, Ryan Reynolds production house on the Football TV itself, right? This is a wild card. It will definitely drive revenue in that sense because of the celebrity Ryan Reynolds himself, right? And that will definitely drive advertising. But to me, this is a wild card. It definitely drives revenue, but to what extent is it overrated right now? I'm not very sure, but I definitely am positive about that. So right now in this current short term, in this Q4, advertising rate will probably increase because of the midterm elections and current the World Cup. So that will help Football TV drive out their advertising avenue, and probably lesser cash burn in that sense. So I hope this short term, hopefully this will drive the short term price in when they report their revenue and their profitability in the next 10Q in I think in January or early February if I'm not wrong. So I hope that could drive the share price upwards. And there's actually an interesting catalyst in 2026 where the host of the next World Cup is US and Canada. And US and Canada is actually playing quite well in the current World Cup. So if they are the hosts, right, it could even drive more, I would say more, there will be more focus in the US and Canada's US and Canada focusing on the World Cup, and then there will be more advertisers driving revenue on it. And then definitely I would say, right, that's a very interesting catalyst in the long term itself. So there's actually, in a summary, there's actually a lot of catalysts in my opinion. There's a lot of tailwinds, especially in 2023. So however, I'm not going to so for the conclusion, I don't have any valuation or looking at ratios, because the idea of this company is a turnaround and expected to generate free cash flow in 2025 via sustainable and profitability growth. And I do want to say that there's actually a lot of catalysts right now, as explained just now, but the company is priced for bankruptcy. It doesn't make sense to, as a hodler, to sell now, right? But execution remains key for this company. Similar to Digital Turbine, where I stated that this is so important, execution of 2023 remains key. And if there's any cash call in 2023 itself, that to me is very negative and definitely telling me that I just have to sell off, because they emphasize so much on that in 2023 there will be no cash call. However, that remains that this company remains a speculative company in the sense with calculated risk, right? If I'm not vested, I'll definitely not have gone for Football TV. But if I'm interested, I will only put in a small allocation. So anybody who has gone through, who is interested after staying on this YouTube video up to now, right? If you want to buy in as a new position, please do a small allocation only. For myself, since I'm already vested, I'll continue to hold on to it. And if there's a run up in the share price in the near term, I'll reduce my position, right? So as you can see here, hodlers, in my opinion, is not a smooth journey. Definitely, as a Football TV hodler, it's not a smooth journey. But let's hold through after the World Cup and probably into 2023. I see improvement from there right now, because as I said, as I shown here, company is primed for bankruptcy, but it's not, right? They will have enough cash for 2023, and if they execute well, things will be better. And if their flywheel works, more interactivity, more engagement, more upselling, more features, more advertisers, right? Everything will work well, and then eventually, right, the share price will go up definitely if that actually become true, right? So without further ado, thank you very much, and I'll see you in the next video. Please like, subscribe, and I'll see you in the next video. Bye.